Gold is if this is a continuation pattern in the range. We've got to remember silver's high was 120 and its low looks around 64. 121, 122, and 64. It's almost a full $60 in that. Gold has done the best out of all of this. It's in a minor corrective, which we suspect could be an upside, which still go for now soft view, lightly held on the falling wedge structure. Anything that smashes it down harshly through this basing, descending grind line. So if it were to spill through that, changes us to a more bearish perspective, and then we think the percentage, which is probably 45, 55. So 55 for staying in range right now, with gold doing this. Of course, silver will follow. Of course, there's engineered shortages. Our targets of 333 on the big time frame still remain. And in fact, you are in the pullback phase.
Gold and silver are currently navigating a critical consolidation phase, with price action suggesting a continuation pattern rather than a completed move. Silver's wide range between roughly $64 and $120 highlights the scale of volatility, while gold has remained comparatively resilient, holding within a softer corrective structure. FrancisHunt, a technical analyst known for momentum and pattern-based forecasting, outlines that gold is forming a falling wedge, a structure that often resolves to the upside if support holds. However, a decisive breakdown below the descending trendline would shift the outlook toward a more bearish phase. For now, probabilities slightly favor continuation within range, with gold stabilizing while silver tracks its direction. The broader setup remains intact, with long-term targets for silver still pointing toward significantly higher levels, including the 300-plus range on a macro timeframe. This current phase is viewed as a necessary pullback within a larger bullish cycle, where volatility resets positioning before the next expansion. Now we present the clips from FrancisHunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold has done the best out of all of this. It's in a minor corrective, which we suspect could be an upside, which still go for now soft view, lightly held on the falling wedge structure. Anything that smashes it down harshly through this basing, descending grind line. So if it were to spill through that, changes us to a more bearish perspective, and then we think the percentage, which is probably 45, 55. So 55 for staying in range right now, with gold doing this. But if you break here, you might go closer to 49, 51. And if the minute you start running 4 6s, you start to bring the test of the 4 as the priority base case on your probability-ometer. So we are waiting to see what the market does. We don't do a lot of updates while we're waiting to see. The market needs to talk and to tell us and to give us more views. But I am giving you this possibility here to see whether it breaks upside on a falling wedge downside, or just tapers into the point and then makes a decision to go upside or downside. So we'll have to see. Typically when you get constriction, ergo the falling wedge, you get an impulsive move. So that's why we are forewarning you of either a stab upside or a stab downside. That's not directional. What we're actually saying, the volatility may increase again soon, and it's currently squeezing. If it's a falling wedge and you're in a macro continuation, we'd probably bias to a stab upside and the beginning of that third impulse, which would be the scenario of in-range continuation. In-range continuation. The range is the 5-6 to the 4-4. That would be the scenario, which would then eventually lead to an upside breakout with quite a substantial move potential with an upside HVF, which is a common occurrence when you get in-range continuation. Okay, if you don't and you start falling out the bottom, then we're talking about this crisis escalating more seriously, and that could get very, very interesting. Don't expect to have the cash price be your purchase price for any investments you make in bullion. All our investments in bullion are long-term. I don't actually keep much personally at home at all, and I am utilizing non-politically exposed vaulting services there where I have a real personal relationship with the owners. And I would suggest where we introduce community-based investment as well. So I suggest that's probably your best, as crime might go up in terms of a lot of threats, in terms of your own personal strategy. Those are long-term holdings. I have no interest in trading in and out of those. Those are for the next 5-10 years to see reset out. And I expect at some point they will attempt to come and tax scavenge against you for those ill-gotten gains in their mind, because you are a pet rock hoarder and must be punished because you didn't go down in your wealth standings like all the other peasants that they want to terminate. So you've got to think about preserving your wealth so that you don't become ward of state. You've got to think about building your wealth first before preserving it, and you've got to keep building it, not for the sake of money. I don't think there's anything I want that I can't already buy, that I don't already have. I'm talking about securing my lifestyle. I'm talking about mobility, freedom, multiple jurisdiction, optionality, and the ability to pass on good wealth and a great start to my next of kin and next generation. These are the things that actually motivate me, and working against a parasitic, predatory, pedophile class that is actively working against you. That is what you've got to acknowledge. That is what you've got to accept. Fiat and debt debasement is absolutely going to be in an acceleratory phase, and the final and most clear-cut preserver of wealth will be gold. The Ernest Hemingway curve is like this, and you are now in the acceleration phase to the downside, where the full losses of the excess debt are about to be realized, even though they were building up, and we should have re-rated by debt as they were building that debt up. What we've actually done is they've masqueraded and hidden the full corruption of the financial system, so that the full debasement suddenly occurs and you get a mark-to-market of true value in a crisis event. They will pass off the inflation that comes, that is needed to destroy the debt, and they will pass off the subsequent interest rate hikes that will go associated with the devaluation of the debt. They will pass off the hyper-stagflationary world that you are living with, the cost of livings, as being the cost to the planet for reducing the risk of Iran's nuclear threat. That is the smokescreen. They will pass, just like in the 70s, they passed off the oil price on OPEC, when in actual fact they were utilizing the oil price and helping support and create OPEC so that they could have a cartel of oil-based extraction, for which many of the oil owners are in London, United Kingdom, the Rockefeller clan in the United States, to benefit at the cost of the consumer, and at the same time run down the value of the fiat on the excess debt they created during the Vietnam War, the tail end of World War II, and everything else they did that enriched themselves through the military-industrial complex. So now you find yourself in a similar cycle, only this time you didn't have gold as a restricting agent that they got bust the minute they started to cheat on. You've had the rev limiter off. The engine has printed so much fiat that the debasement is going to be on a far greater scale. So that was the junior leg, the junior cycle of 1913 to 1971. You're now facing the mega cycle, where all the sins, where they've been uninhibited by a gold price, will suddenly be unveiled, and it is going to be brutal. That is why you will have a curve like this. And the only antidote is what gold will do, which is what it always does: preserve capital and absolutely mimic the opposite curve, which means it is preserved value almost perfectly through those two curves, a parabola to the upside. Of course, silver will follow. Of course, there's engineered shortages. Our targets of 333 on the big time frame still remain, and in fact, you are in the pullback phase. And I will do that chart on account of my closing thoughts here, just to remind many, because I know there's many silver investors, and I am one, and I will keep volt stacking on that one. Many people need to be reminded of exactly what we're saying. You are in that pullback phase that we warned would come once you made the second interim. Despite that, we had on the lower time frames many setups when others were saying there's no low risk entries. We had many options and ability to actually maximize during this period. Only if they're trading one time frame was the low cost entry gone. We highlighted that this was your primer. That was the Brent Johnson headless chickens call pilgrimage. That was at, as we were passing 25.9, we said the primer has broken and this larger move will start. That is the equivalent of the the Brown's bottom on selling all of UK's gold, I would argue. Here you had the second. There we go. This setup is good. You ran the second interim and you are facing this pullback period for this 3-month quarter in review. And it may take the whole quarter to do it. It may take a little bit longer, or it may start going back higher green during this quarter. However, I would say we are in the 17th of March. There's only 2 weeks left. So I suspect that this will probably remain somewhat of a shooting star. That will resemble that. I will draw that upside HVF for silver because everybody was saying, oh, I see you're not talking about silver anymore. There is unfortunately quite a low common denominator of this. We talk about things that are interesting at the time and that are set to move. And we let things rest when they need the time to rest. None of what we said before is invalidated. All that's happened is due course and processes taking place. And as a result of that, let's just go back up to our monthly time frame. Unfortunately, we have to keep resetting this. So this is the HVF for the upside on silver, so that those that haven't seen it can just be reminded. It is doing everything it should be doing. It is doing absolutely everything it should be doing by now. It is going into a quiet lull phase during the period. During the period, you ran your second interim. Second interim is an absolutely huge move that you have done. You've got to bear in mind something that has been stuck in this range, traded 120. Let's just get that top again, 49,81428. Let's get it in, 49,81428. That's what I thought I put, 49,81428. Let's just get in an 81428. Come on. It sometimes takes a while for the jaw to pick up the imperfection that we put in. Let's have a look, have a look. Come on, come on, come on, come on. Oh, I didn't tick the box. That might be why. So let's see if we can get that jaw up. It will eliminate that particular high. The other detail that I also want to make quite apparent on all of this is that the 50, there was a 50 trade. This actually is higher. This H1 is higher. We shouldn't need to correct for the imperfection. We shouldn't need to correct at all for it, but we are, because the true high was not reflected. So there you go. There's that interim at 90.5. Now I stress and highlight that the interim comes from the geometry from the RH2. We actually reduced the RH2 so that it's not higher than the high one. And the only reason it's we had to make it imperfect like that is because the high one is not being truly reflected where it should be. So that is part of a data problem. The Hunt brothers did actually take in during the 80s through 50. And that is largely accepted, which would mean this isn't totally perfect. This would increase the second interim by a handful of dollars. At the moment, we've got it sitting on that one, the high, which is at 44, whilst the actual high was 49. So we would have had an additional $5 on that. That would have made it around 95. So the second interim in truth would be there, and that would be 51, which is why we've also moved just under 51, why we've also moved the target by $3 to get the funny number of 333. Lots of explainer to do. Imperfect world, that's what happens. There was the beautiful primer. This is why you rest. This is a shooting star, which can mean localized pause. If we were to get the credit crisis, you could sell off quite some way and do eventually a hammer there, and you could have a green or a red candle and a downside wick like that. If we were to go full credit crisis, I think that would occur. Don't expect not to pay premiums at any of these prices if that was to happen. However, you also can just go straight into a spinning top and pause and then start building for more upside. So it depends. It depends on the degree of liquidity threat that the world will face regarding this debt unwind. Is this the debt in mind of reset, or is it a partial tremor before further ones to come later when metals are higher up? You could get the debt, full debt post 330 being run on silver, and then you could have silver come down quite a long way, say to 180, which would actually represent, a correction of $140, but from a much higher point. So we don't know the timings of that. We don't pretend to know it, but I do feel that it is serious, the private credit. So it could happen here at the second interim, and the drive up through 330, eventually to single-digit gold-silver ratio, could all occur as part and parcel of the solution to the credit crisis that occurs at the interim level too. So you choose which one it is. Could be credit crisis here, pullback, and then go all the way to 333 and beyond on the solution. I think that's a possibility, which could mean then that we'll still pull back for a little longer and the pattern will extend.
Gold is currently holding within a tightening corrective structure, forming a falling wedge that signals an imminent volatility expansion. Price compression between key levels suggests a decision point is near, with probabilities slightly favoring continuation within range unless a decisive breakdown occurs. The broader framework highlights a range-bound environment between approximately 4,400 and 5,600, where any impulsive move could define the next major trend. A sustained break higher would support a continuation pattern and initiate the next bullish impulse, while a downside breach would shift the structure toward a deeper corrective phase. Silver remains in a pullback phase following a powerful interim advance, aligning with typical cycle behavior where consolidation precedes expansion. Long-term projections remain intact, including significantly higher targets driven by structural imbalances and tightening supply conditions. At the macro level, ongoing debt expansion and currency debasement continue to reinforce the role of precious metals as a long-term store of value, even as short-term volatility resets positioning across the market. Let's get back to the interview.
Silver is in the mix too, and will initially follow gold in terms of whatever happens. It will initially follow gold in terms of what happens. Right now, the falling wedge possibility, which is a scenario softly held, ready to be disproved or broken. It's early called. We like to be early. Traders who wait for confirmation have terrible RRRs. That's right, they sound like a pirate. Risk-reward ratios. You don't wait for a moving average to give you confirmation. That is absolutely stupid. It's newbie talk for anybody trading. The earlier you get in on a view where you can be close to a tight, clear, based stop, the better your trading will be. You will be stopped out more often. It will be much smaller stops, managing and learning to take regular small losses, sometimes entering 3 times and winning on the 3rd or 4th is still good when you get very expansive rewards and you are taking very tight losses. An example of that is you could get a 3rd impulse and it could trade down. It might make a double bottom and fail to make a new low. These are marginally lower lows. That's actually bullish. You could fail to make a new low on a wick. If you were to jump and enter there and go just a couple of ticks below there, you could have a very tight risk scenario. For an example, if you were to go sideways and up with a down leg and make a very close to double bottom there. So a couple of ticks below, you could grab a stop loss over there. And then if it were to break and go on up for a bit, that could be a manufactured entry. Do I really want to do that as a big, high probability, my mega trade? No, the next mega trade on gold is if this is a continuation pattern in the range. We've got to remember silver's high was 120 and its low looks around 64. 121, 122, and 64. It's almost a full $60 in that. That's going to, in due course, potentially, if this remains in range, please note all the if this, then that. This is like a nested if statement. The minute it runs 63, it's not an in-range continuation pattern, as we discussed with gold, and that's likely to happen if it's not happening for gold. So silver will follow gold until it's ready to dominate. After a major reset in the leverage, gold leads first. That's why I've spent the bulk of the time talking gold. So wherever gold leads, silver will probably follow, and then later will start underperforming once the confidence starts to return. So initially we'll trade gold, but we'll be keeping an eye on silver for that moment where it starts to express itself more expansively. Technically, you've got a long way to make a high. This is only around the 50%. So if we do the same fib on here, silver wore the correction harder. So that I imagine most of you will understand and have seen for yourself or seen for yourself. Let's just remove that. And I want to make sure I pick the low there and just remove that line. There we go. So you can see for now, compared to gold, silver is hanging heavier in the range defined by the correction, the leverage clear out and correction. So if we just turn that off, we need it on for the range. I've got quite a bit of drawings on here, so it's kind of messy. But you can see that the 50% mark here is around the $92. We weren't able to hold the 92. You got rejected there and you got rejected there. So you are hanging lower right now. You are hanging lower. Some might say that could be a bear flag. As I highlighted on gold, the fact that you went to 78.6 rebuked, in fact, it was 80 plus. You went through the 78.6. Refutes the bear flag theory for gold. If gold's not a bear flag, it's unlikely that you're going to be getting bear flag targets out of silver. Unless gold sells off brutally to the bottom end of its range, you might just get an overreaction from silver. But again, also, there is a basing descending grind line that is supporting this. That's part of the falling wedge theory that we've been discussing on both of them. And that points to there is some degree of support that is happy to just keep putting in limit offers below the price range and continues to buy it. Not follow through and chase, but there's smart money buying anybody who's panicking. There's panic sell, smart money ready to come in all day long at the 70s level, it appears, and buy it up in and around up to approaching 80. So 77, 78, it's going to take a big piece of news for that bid to go away. They keep coming in. So I don't think that is bear flag territory because of gold's position, because of gold's degree of rally. So silver is just a bit weaker right now due to that. If we put the volume by price, you'll see it will be hanging lower than gold. But again, the key is gold, not silver at this juncture. It's only just below the 38.2, but the 38.2 it's about 36%, I would say. It's about 1/3 of the way up, just past 1/3 of the way up. But you did have a huge smackdown and you did an unbelievable run up there as part of the blow up to trading 122. So that value at the 38.2, in fact, is around, in fact, let's just do it, 83 and a half. Is where, as I've mentioned, the 90 seems to be an area where you're continually rejected. So that is silver. Also, because of the industrial component, and we're getting a little bit of a bad economic vibes brought about, in economic activity will drop if costs on a number of things. Don't forget, it also includes fertilizers and food, everything that doesn't get transported, a lot of it. We could see, for example, you came up and then you made an ascending broadening structure. That was a warning. That's a megaphone on a bull pole with an ascent. You would expect that to break, and it did. You then got a kind of double bottom, but it never followed through on that double bottom. It made a smaller double bottom target, but never followed through to ran that. So it's remaining in range. A little bit of upside, a little bit of downsides, not much. It's remaining in range and hanging slightly heavier for now than the gold overall.
Silver remains tightly linked to gold's direction in the current phase, with price action suggesting a continuation structure rather than a completed trend. While gold holds relatively stronger within a falling wedge formation, silver is lagging slightly, trading lower within its corrective range after failing to sustain momentum above key resistance levels near $90. This divergence reflects a typical cycle dynamic where gold leads early and silver follows later with greater volatility. The technical structure shows silver hovering below mid-range retracement levels, with repeated rejections confirming overhead supply, while consistent buying interest around the high $70 indicates underlying support from stronger hands. This creates a compressed environment where liquidity is being absorbed, often preceding an impulsive move. The broader setup suggests range continuation between roughly $64 and $120, unless a decisive breakdown shifts the structure into a more bearish phase. At the same time, macro conditions, slowing economic activity, industrial demand sensitivity, and ongoing monetary pressures are contributing to silver's relative weakness compared to gold. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Thanks for watching.